Hello everyone, here I am once again talking about those darn electric bills. It's a lot to cover in these 3-minute reels one at a time. So if we want to lower electric bills long term, we have to change 3 things, but I want to set realistic expectations. We're probably not going to lower electric bills anytime soon. The IURC has already approved rate increases that are built into their current bills, so we might occasionally see temporary relief when certain costs come off the books, but with continued population growth, new infrastructure investments, and rising energy demands, those savings are often replaced by new expenses. So moving forward, the fight isn't really about lowering bills, it's about slowing how fast they keep rising. And that brings us to 3 big questions. How is risk shared? How do utilities make money? And how do consumers actually have real choices? Because right now, most of the financial risk falls on everyday families, while utilities continue operating under rules that were largely designed to protect revenue first. For years, Indiana's had a pretty simple formula: spend money, recover costs from customers, and earn a regulated return. That's how the system was designed back in 1913. Then, as electric bills became unbearable, people began asking whether the balance has shifted too far away from the customer. And this year, the Indiana legislature acknowledged those concerns with House Enrolled Act 1002. This bill was Indiana's acknowledgement that the old system had problems. The law introduced performance-based rate making and multi-year rate plans. In plain English, utilities shouldn't just be rewarded for building and spending, they should also be accountable for the results they deliver. House Enrolled Act 1002 also includes new transparency requirements and low-income protections. Now here's the important part. This is a significant reform, but it isn't a complete rewrite of Indiana's utility system. Utilities still operate monopoly service territories, recover major infrastructure costs from customers, and earn regulated returns on those investments. What changed is that Indiana began adding accountability measures to the existing structure. Put simply, Indiana didn't abandon the old model, it softened it. So where does that leave us? Indiana has already begun reforming its utility system. The question now is whether those reforms are enough to meaningfully protect ratepayers and slow the growth of future electric bills. Are utilities taking on enough risk? Are the new performance measures strong enough to make a difference? And will these changes actually lead to better outcomes for customers? Those are the questions that will help shape Indiana's energy future. Over the next few videos, we'll explore the 3 biggest paths for change, how risk is shared, how utilities earn profits, and whether consumers should have more options. We'll also take a closer look at the ideas many of you have suggested in the comments, including whether another utility such as Duke Energy could acquire CenterPoint, and whether municipal utilities or REMCs should be allowed to expand into territories currently served by investor-owned utilities. And as always, I'm honored to serve, and I am happy to take your comments as long as they are kind. Thank you.